salary or hourly pay, which is better for your career and financial goals. This fundamental employment distinction affects everything from your paycheck stability to your work-life balance. At its core, the difference is straightforward. Salaried employees receive a fixed annual income divided across pay periods, while hourly workers are paid specifically for each hour they work. However, these different payment structures create cascading effects on benefits, legal protections, and career trajectories. Salaried employees operate under a contract that specifies their annual compensation, typically divided into weekly or bi-weekly payments based on the standard 2,080-hour work year. One key characteristic of salaried positions is that employees generally don't track their time through timesheets. Whether they work 35 or 50 hours in a week, their base pay remains consistent. This payment stability is a major advantage of salaried positions. You know exactly how much you'll earn each pay period, making financial planning more predictable. Salaried roles often come with additional benefits like health insurance, retirement plans, paid time off, and opportunities for bonuses and annual raises. These positions typically offer greater job security and clearer paths to advancement into management. However, salaried positions have notable disadvantages. Many salaried employees are classified as exempt from overtime under the Fair Labor Standards Act, meaning they don't receive extra compensation for working beyond 40 hours. This can lead to expectations of evening and weekend work without additional pay. Once you accept a salary, renegotiating it often becomes difficult without changing positions entirely. Hourly employees, by contrast, are paid a set rate for each hour worked. Their compensation directly reflects their time investment. Hourly workers typically use time cards or timesheets to verify their hours for payroll purposes. Full-time hourly employees generally work 40 hours weekly, while those working fewer hours are classified as part-time, often with different benefit structures. The primary advantage of hourly work is compensation for every hour on the job. When hourly employees work beyond 40 hours weekly, they typically receive overtime pay at 1.5 times their regular rate. Some industries offer double wages for holiday work. In positions where overtime is common, hourly workers may actually earn more annually than their salaried counterparts in similar roles. The main disadvantage of hourly positions is income instability. If business slows and hours are reduced, paychecks shrink accordingly. Hourly workers are often more vulnerable during economic downturns, facing reduced hours or earlier layoffs. Some hourly positions offer limited benefits, especially for part-time workers, and fewer opportunities for advancement. Legal classifications significantly impact these employment categories. The Fair Labor Standards Act establishes whether an employee qualifies as exempt or non-exempt from overtime requirements. Exempt employees are typically salaried workers earning above $35,568 annually in 2024 and performing executive, administrative, or professional duties. Non-exempt employees, usually paid hourly, must receive overtime pay for work exceeding 40 hours weekly. State regulations add another layer of complexity. California, for instance, has stricter salary thresholds and overtime rules than federal standards. Employers who misclassify workers face serious risks, including lawsuits, back pay claims, and penalties. Tax implications also differ between these payment structures. Salaried employees benefit from consistent tax withholdings, making budgeting simpler. They often have access to employer-sponsored retirement plans and pre-tax benefits like healthcare savings accounts. Hourly workers may experience fluctuating tax withholdings based on their changing earnings. Those relying heavily on overtime might face higher tax liabilities, though lower wage, hourly workers may qualify for earned income tax credits. Career advancement opportunities typically favor salaried positions. These roles often have clearer promotion pathways, structured performance reviews, and established salary negotiation processes. Hourly employees may find career growth slower, though transitioning to salaried positions remains possible as they gain experience. During economic challenges, companies typically protect their salaried workforce longer, providing greater job security. When choosing between salary and hourly compensation, consider your priorities. If you value predictable income, comprehensive benefits, and clear advancement opportunities, salaried positions may be preferable. If you prioritize being compensated for every hour worked, potential overtime earnings, and schedule flexibility, hourly work might better suit your needs. The ideal choice depends on your industry, career stage, financial goals, and personal circumstances. Understanding these fundamental differences helps you navigate employment decisions that align with both your immediate needs and long-term aspirations.